So today's screencast is going to kind of look at some of the more practical aspects of what goes into earnings and some of the reasons why earnings may vary so much. So in the last chapter, we looked at the way marginal revenue product and the supply of labor combine to create the overall wage rate. In this chapter, we're going to look more at some practical aspects of what are the other factors that go into creating wages. So in the United States today, wages really vary. The typical physician earns about $200,000 a year. The typical police officer earns around $50,000 a year. And the typical farm worker earns about $20,000 a year. So what are the factors that go into this wide disparity of earnings? Wages are governed by the laws of supply and demand. Workers are paid based on their marginal productivity, right, or the value of the marginal productivity, really. And they're paid based on their contribution to the value of the overall economy's production of goods and services, most of the time. However, there are some other factors that come into play. And the factors we're going to look at today are compensating differentials, human capital and signaling, ability, effort, and chance, the superstar phenomenon, and discrimination. So a compensating differential is when a worker is paid based on a difference in the non-monetary characteristics of the job. And this should be kind of pretty straightforward and make a lot of sense to you. Workers are paid more when a job is filthy. Mike Rowe had that famous show, Dirty Jobs. When somebody is doing a job that nobody else wants to do, they're going to make more. Workers are paid more when jobs are dangerous, when jobs are dull, if they're required to work out of doors more often, if they're required to work the overnight shift. So a nurse who works overnights all the time is generally going to make more than a nurse who works the day shift all the time. Another factor, and probably the most important factor, is human capital. Human capital is the development of skills and ability through education and on-the-job training. The most important form of human capital is education. And the most important investment you can make is in education. Education represents an expenditure of money at one point to raise productivity in the future. By 2003, a male with a high school or with a college degree earned 82% more than a male with a high school degree. A female with a high school degree or with a college degree earned 71% more than a female with a high school degree. So what's happened is, and we're going to look at this chart and we're going to talk about it in a lot more detail in class, what's happened is college education has gotten increasingly valuable. Sorry about that, right? College education has become more and more valued by the economy. And at the same time, workers with higher levels of education face less unemployment. So what you see here is overall education level compared to income and overall level of unemployment. So the higher the level of education, the overall lower the level of unemployment, generally speaking. There is a competing theory of education that's known as the signaling view of education. So the human capital view looks at education and they say, is the more educated you become, the more productive you become, the higher your marginal product or the value of the marginal product of labor is, right? The signaling view basically says that firms will hire high education people, high education workers, simply because they can. They can hire high educated workers, so they do. It's rational for firms to see somebody who achieves a college degree is a signal of ability. Now, does that mean that workers with college degrees are necessarily more productive than other workers? No. It just means that firms have the opportunity to hire college educated workers, and they do. Another factor that comes into play is ability, effort, and chance. Natural ability is important in workers of all educations, and there are many personal characteristics that are going to determine whether or not a worker is going to be more productive and more valued by society. Work ethic comes into play. There's a lot of other factors that come into play. We're going to talk about some specific examples of this in class. The superstar phenomenon is related to ability, effort, and chance, and it kind of tries to explain why professional athletes, musicians, and workers in industries like that can make so much money. And it's the idea that technology is present that allows the worker's product to be delivered to a large number of people at one time. And small differences in ability create large differences in potential outcome. My favorite example of the superstar phenomenon is Michael Jordan. So at the height of his career, Michael Jordan made about $40 million a year. This is in the mid-1990s. Now, when you think about it, it's logical for Michael Jordan to have been paid $40 million a year, though, because I would argue that Michael Jordan had at minimum 40 million fans worldwide. And if each of those fans was willing to pay Michael Jordan $1 a year to play basketball, right? That means he's worth at least $40 million. He was actually probably worth far more than that if you think of all the extra value he created elsewhere in the economy for companies like Nike and Gatorade and Hanes and all those endorsement deals that he did. Now, the next thing we want to talk about is why would some firms choose to pay workers wages that are in excess of the equilibrium wage? And there are kind of three basic explanations for why this happens: minimum wage laws, the power of labor unions, and efficiency wages. Now, minimum wage laws we've kind of covered in great detail already. I'm not going to spend a ton of time on that. A minimum wage is simply when the government sets a price floor on labor. You're not allowed to sell labor for less than that price floor. Labor unions are workers' associations that bargain with employers to raise wages and improve working conditions. Labor unions will often do this under threat of strike. A strike is an organized work stoppage, right? It's a withdrawal of labor from the union. And firms will sometimes be willing to negotiate higher wages with labor unions because the workers have a little bit more market power. Sometimes, however, even in the absence of unions, firms may find it actually profitable to pay workers above equilibrium wage. This theory is called efficiency wages. Firms may find it profitable to pay efficiency wages because it reduces worker turnover. You have to hire fewer workers. It makes workers work harder. And it will also raise the quality of workers that apply for jobs at the firm. So kind of an example of efficiency wages at work is if you compare Walmart and Costco. Walmart kind of has a history of paying below or equilibrium wages that are equal to the minimum wage, while Costco has a history of paying workers above equilibrium wages. Costco pays workers about $13 an hour right now. This is 2016. And they actually find it to be profitable because they find that they attract a higher quality of worker and their workers tend to stay significantly longer. Now, the next topic we want to talk about is discrimination. Discrimination is the notion that you're going to treat workers or people differently based on a characteristic that's beyond their control. Okay, so for example, race, ethnicity, gender, age, other personal characteristics. Now, discrimination is an emotionally charged topic, and we're going to look at it from an economic perspective. In class, we're going to look at it more from a sociological perspective, and I'm going to give you some kind of different arguments that come up when it comes to discrimination. So, labor market discrimination is usually looked at by measuring the average wages of different groups. This is sometimes a little bit problematic because different people have different wages. So one example of labor market discrimination is the pay gap between men and women. And that's the one that I'm going to kind of focus on right now, because it's sometimes the most clear pay gap that you're going to see. And currently today, the average man makes about the average woman makes about 77% of what the average man does. Now, there are many reasons why wage gaps exist. One factor is different levels of human capital. Simply examining differences in wages among broad groups says little about the actual prevalence of discrimination in the labor market. Okay? Because there are differences in wages between different job characteristics, different amounts of human capital, compensating differentials, just looking at differences in wages isn't really going to tell us a whole lot about how much discrimination is in the workforce. There's kind of an economic argument that competition will tend to actually limit discrimination by employers. If employers really care about maximizing profit, they're going to look to hire the lowest paid workers. And firms that don't discriminate will tend to be more profitable than firms that do discriminate. So there has to be some alternate explanations. And what most economists will actually tend to point to is discrimination based on customer preference and government policy. So if customers have discriminatory preferences, firms may try to discriminate just to satisfy the desires of their customer. And customers may be willing to pay more to engage in discriminatory practices. We're going to look at this in a lot more detail in class, this kind of idea of discrimination by customers and government policies. Now, sometimes government policy may force discrimination. So a great example of this is Jim Crow South, where it was literally illegal for different races to take different jobs. Again, we're going to look a little more closely at discrimination in class.